Hello everyone, this is a quick tutorial on using the Excel basic data functions to get the summary statistics for your return data for the portfolio report 1. Now I've downloaded some data for 30 Canadian stocks, downloaded both the price index and return index data from data stream. I'm going to work with the return index data that does include the dividend payments in itself. So some of the companies that I will use in my example, I'm just going to pick the first 5. This is Akita Drilling, Algoma Central Corp, Andrew Peller, Adcor, and BC, as well as the TSX Composite Index. My data is quite long. It starts from January 1st, 1999 until March 2014. So some of these dates might be worthwhile removing for the purpose of the example, so we don't have to deal with such a long history of time. So I'm going to remove some of these dates, earlier dates. I'll keep the financial crisis just to give you an appreciation of the difference between when markets are in distress and when markets are in their normal state. I'm going to leave the first date, the last date of the 2007 to be able to estimate the return for the first day of the 2008. I'm going to delete all of this. And now I'm simply going to construct my returns. So I'm going to have my log returns on this part of the spreadsheet. Here is going to be my date, S&P, TSX index. My first stock is Akita Drilling. And I'm going to copy that for other stocks, and my last one should be the BC. Okay, so date is the same date reference here. Now my returns, and I decided to use log returns. If you feel that you need to use simple returns, you may use simple returns as well. In case of simple returns, you would have to have the price today minus the price yesterday, and all of that divided by the price yesterday. That would be the return, simple return. I'm going to stick with log returns. So I'm going to take a natural logarithm of the ratio between the two prices, so price indices here over this one. And I'm going to copy this for all of my stocks that I have. So, sorry, I didn't have this one. I'm going to drag the formula reference down to the last available observation that I have. And the returns using the formula I specified in the very first row in the beginning will be implemented for each single day. So here are simply my dates. Now, what I'm going to do is I'm going to estimate the expected returns, standard deviation, geometric return, and the number of observations. These are the components that you will have in your summary tables in the portfolio report 1, second part. Now, expected returns are quite easy to estimate, so we can do that for the TSX index and for one of the companies. Let's say we're going to take the Akita. You simply can use the average function and select the full range of the returns available for all of the years. That will give you the average daily return for all the years you selected. Now, this is the average daily percentage return on the TSX Composite Index. However, normally we would want to represent this in the annualized form to see what's the average percentage return that we get on the Canadian market. So I would multiply this figure by 250 and it would give me percentage of return on the TSX index. I can do exactly the same for Akita. I'm going to take the average and I'm going to use the reference here. It's easier to modify it slightly than selecting the data every single time. Paste it here, but only I'm going to shift it for the Akita, and also I will multiply it by 250 to represent it in the annual form. Now the factor 250 is selected as ad hoc. You can use 250 or 255 or find the actual number of trading days available in that particular year. You can see that over the period from 2008 to 2014, Akita drilling did outperform the TSX index by approximately 5%. These are the average figures. Now we want to find out whether the risk of a single stock or a single investment in Akita drilling was higher than investing in the TSX composite index. So we want to investigate what is the standard deviation of these two securities. There are two options that you can use for the standard deviation. It's either the sample standard deviation or the population standard deviation. It really wouldn't matter if your sample size is larger than 200. The two numbers will be almost identical. However, the sample size is smaller than 200, you'll probably be better off with the sample standard deviation. Now, it really doesn't matter which one to use as long as you use it consistently. If you started off using standard deviation for the sample, continue using it when you're comparing the numbers. If you selected to use standard deviation for the population, continue to use it consistently for other securities and for your other calculations. I'm going to stick with the sample standard deviation. I do have the reference for the TSX already in my clipboard. And the standard deviation, if I present here, is the daily standard deviation. This figure is somewhat awkward because normally investors and clients, they are used to annual representation of risk. So we want to annualize this number, and the way we annualize the standard deviation, since it's square root of the variance, we multiply it by the square root of our annualization factor, which in the previous example I used 250. Now 21% is the risk on the Toronto Composite Index. I want to see whether the risk of Akita drilling was higher than that of the market. So the standard deviation numbers for Akita drilling, I'm gonna annualize it right away by multiplying it square root of 250 to get the percentage, and it is 36%. So the risk for Akita drilling was higher than that of the market, but I did receive higher return on that particular security. You can check for other companies if you wish, and actually you will check it for other companies, for all companies in your portfolio reports. Now, geometric mean, there's a function in Excel called the geomean, and if you use this function on the returns, say for the index, that will give you an error. Now, the reason behind that is the geometric function and the formula for the geometric mean doesn't use the return itself. It calculates the geometric mean on 1 plus the return on the company. So what you have to first do is to construct an additional several columns, each column for each additional security that you have in your portfolio, and simply add 1 to all of the returns that you've already calculated. Now, if you use the geometric mean function on this modified return column, or gross return, this number will be correctly estimated, and the geometric mean will be displayed. Now, to do the proper annualization geometric mean, first I have to minus 1 and then multiply this number by 250. So the geometric average here is 1%. Now I'm going to do exactly the same for Akita. So I'm going to take 1 plus the returns on Akita and copy it down, and I'm going to estimate the geometric mean for the Akita drilling using exactly the same format that I used before. The only thing is the return reference will be different. So you will see that the geometric average will always be lower than the arithmetic average, and the difference between the arithmetic and geometric average will be larger. The larger is the standard deviation. So the difference between the arithmetic average and the geometric average in the case of the Toronto Stock Exchange was approximately 2.3%. The standard deviation is 21. The difference here is quite more significant, but this is due to the fact that the standard deviation was higher in this particular case. To count the number of observations used in each of the series, you can use the function in Excel called account. Sorry, not account, count. I'm gonna use the same. It doesn't matter which reference you actually use because it's in the table. So any way you calculate it, it's gonna give you this. So there's 1.6 thousand observations available. So it doesn't matter if you calculate for it; it's going to be exactly the same. Now you can do the same analysis year by year and calculate the expected return, standard deviation, geometric mean, and the number of observations for the year 2008, for 2009, 2010, and so forth. And then you will observe that the standard deviation varies and normally would be much higher during the global financial crisis in 2008 and maybe spilling over a little bit in the beginning of 2009.